This is Street Signals, a weekly conversation about markets and macro brought to you by State Street Markets. I'm your host, Tim Graff, head of macro strategy for Europe. Each week, we talk about the latest insights from our award-winning research, as well as the current thinking from our strategists, traders, business leaders, clients, and other experts from financial markets. If you listen to us and like what you're hearing, please subscribe, leave us a good review, get in touch. It all helps us to improve what we offer. With that, here's what's on our minds this week. Happy New Year, and welcome back to another year of Street Signals. We've got lots of exciting stuff to work on and talk about this year, and the next couple of episodes, on that note, are setting up to be epic. But it's become something of a tradition for me to ease back into the new year with a review of what happened while we were away for 2 weeks, what the consensus outlook for the year seems to be, and how the big questions of the coming 12 months line up against the message from our indicators of investor behavior, risk, and inflation. The first bit's the easy part. Between December 19th and when I'm recording this on January 5th, there really wasn't much to talk about, in markets at least. U.S. stocks were flat, yields are a touch higher, gold had a final melt up into Christmas, but gave most of that back last week, and the U.S. dollar is a little bit weaker. Volatility in FX markets was unsurprisingly very, very low, and the VIX hit a new low for the year before rising back towards the 15 level. Flows over the last couple of weeks offer a couple of interesting wrinkles that I'll elaborate on later. And of course, as we saw over the weekend, geopolitics is always there to throw up a surprise. But to summarize it quickly, the modest reduction in risk appetite that we saw in early December really didn't pick up speed and get any worse. And the breadth of risk-taking across institutional investor flows has actually been quite positive for all of the last 2 weeks. Flows in the US dollar are perhaps more revealing. The strong selling we saw throughout 2025 has now returned. The consensus outlook for the dollar is still quite negative, and it looks like real money are re-engaging with that view early, before the new year even really gets going. But I'm getting ahead of myself. When it comes to the big questions and consensus risks this year, to my mind, there are three. The first is whether the expectation for another good year for equities driven heavily by US stock performance pans out, or if the fears of a bubble in the AI trade are finally realized. Let's just level set here. The consensus forecast for US stocks is for a further rise of 8% this year, driven by earnings growth of 13%, so multiple contraction actually. European stocks are seen rising 6%, UK stocks by 5%, and Japan is expected to outperform them all, with the Topix forecast to rise 15%. Now, as it was last year, this is an expectation already embedded in many of our measures of institutional investor positions. The aggregate portfolio weight to equities remains its highest since 2008, and the relative weight in equities versus bonds is at an identical extreme. At a country level, the biggest and really the only overweight in investor portfolios is still in US stocks. And within that, IT and communication services stocks are the most crowded, and it's not even really close for second place. But what has gone up doesn't necessarily come down, at least not at the speed some of the bears might be hoping for. In past cycles, those aggregate and relative weights in equities have been much higher than they are at the present moment. The position risks I mentioned in the AI trade have actually been reduced modestly into year-end. Don't get me wrong, they're still enormous, but they're the same size today as they were last year and even the year before that. So at least from the standpoint of investor positioning, I think it's safe to say there is a lot of optimism, but there doesn't seem to be the kind of mindless performance chasing of a bubble in place. And that's from the sector level all the way up to the total portfolio level. And in fact, one of the strongest consensus views that will have another great year for Japanese equities has not been positioned for at all. Real money holdings in Japan are only neutral. Now, Ben Luck from my team liked this as his year ahead trade, and it's got some pretty appealing aspects to it in going long Japan. It's still unclear whether the AI trade is a bubble. It may become one, but given how strong earnings still are in this sector, it's hard to argue for that bubble bursting imminently. I think the key point to finish on when it comes to risks in the equity market versus consensus is the forecasts themselves. An 8% forecast for US equity performance is not a forecast at all. That's just the average calendar year return we've seen on US equities over the last 100 years. And as my new friend and podcast guest David Dredge pointed out last October, that average return has only been observed in 3 or 4 calendar years over the last century. The distribution of outcomes tends to be much more bimodal. Think either a 10% down year or a 20% up year. Variance is what's going to drive returns, and there's nothing we can do to predict the unknown unknowns that will drive that. You just have to be prepared for it. Earnings growth plays a huge part in the outlook for equities, but of course, earnings growth can never get too far divorced from economic growth. This year, global growth is forecast at 3.2% year on year, with the bulk of it coming from an outlook of 4.5% growth in China and 2% growth in the US. And that will likely be a big determinant of where rates go, which is the second big topic I want to cover. In the front end of the curve, the Federal Reserve's projections for policy rates suggest they're now only going to cut one more time, with the inflation forecasts for this year still above target. Rate markets are a little more confident about further Fed easing. OIS markets have them cutting twice, and the premium in the interest rate option market for received positions on 2-year rates is as high as it has been throughout this prolonged easing cycle. Looking around the world, the Bank of England is seen acting pretty similarly as the Fed, cutting 1 or 2 more times, but the ECB is now forecast to be on hold the whole year, and the Bank of Japan is still seen hiking 1 or 2 more times. There are a lot of big questions around these views, with 2 standing out to me. The first is whether the US actually does slow further, necessitating even more rate cuts, or if it's now on the cusp of reacceleration, with fiscal stimulus set to be a support for another year. The second big question is whether any of this means anything for a Fed that's potentially a more politically captured actor after Jay Powell's term ends in May. On the second point, I have no strong feel, but we're regularly reminded, and I think it's true, how the FOMC is a committee. The Fed's the most widely watched institution in markets, and if we relearned one thing in 2025, it's that politicians listen to markets before almost anything else. And there is potentially good reason to ease more than what is projected. The level of our US price stats series finished about 45 to 50 basis points higher than it normally would in a calendar year, which is pretty small considering all the attention given to trade tariffs, how large they were at one point, and whether they would have persistent inflationary effects. It's not impossible, but it seems unlikely that tariffs will be as big a driver of inflation this year as they were last year. If you look at the work of PriceStats founder Alberto Cavallo, tariff effects haven't gotten any worse since the middle of 2025. And with their modest effects rolling off in the spring and shelter inflation in the US continuing to roll over, it's not a stretch to think that the market's inflation forecast for 2.7% year on year on core PCE at the end of 2026 could be way too high. But again, this is already embedded in pricing and expectations. The one thing I feel more confident about in rate markets is that they're less prepared for higher rates or a reacceleration in the US and the global economy. For example, the consensus forecast for the US 10-year yield is for it to be 4.1%, basically all the way out the forecast horizon. That's the same yield effectively as it is today. That's not really much of a forecast, but actually relative to the forward rate curve, it's pretty bullish. I mentioned the large receiver skew in swaptions on US rates, implying a continuation rather than an imminent end to the easing cycle from the Fed. The labor market has not seen any residual tightness or wage pressures because of immigration restrictions. That could still emerge, and it doesn't seem embedded into anyone's expectations just yet. Rate markets are definitely not ready for higher rates or flatter curves in Japan. The same skew between payers and receivers in US rates that I mentioned, for Japanese rates, that's flat. There's no bias towards higher or lower rates. And maybe that's right. But with Japan having their own fiscal stimulus measures about to kick in, looking for US and Japanese rate differentials to narrow further looks a pretty decent opportunity, even if the US does remain resilient. That plays in nicely to our final topic, what's going to happen with the US dollar and the rest of the FX market. Again, to set out the consensus expectations, FX forecasters broadly expect dollar weakness, primarily against the yen, the Australian dollar, the Norwegian krona, and EM carry currencies. Brazil and Turkey are each expected to see their currencies appreciate at least 5% versus 1 year forwards, and only the Swiss franc is seen as a weaker currency than the dollar in the coming year. There's pretty good reason to expect dollar weakness. It lines up with the view and pricing on US rates that I've just gone through. In addition to some of those fundamentals, the real trade-weighted dollar is still at a very elevated level. And as we've talked about a lot on the podcast over the last year, the dollar's negative correlation to equities has been much weaker. And if that's sustained, it has the potential to incentivize a lot more hedging of dollar-denominated assets from foreign owners. But as with some of the consensus views on US equities and the pricing for US rates, this view is already heavily embedded into positions. The dollar is still really the only sizable overweight currency position within the G10. But the challenges to that consensus kind of stop there. As I mentioned at the beginning, institutions are once again selling the dollar in large size. Last year, they sold it on 73% of trading days within the 2025 calendar year. That's the highest proportion of days with dollar selling that we've seen in a calendar year since our flow metrics began in 1998. The second highest year was in 2002, when the dollar was sold on 65% of trading days, and during that year, it fell 13%. What then went on to happen in 2003 is very instructive. The dollar selling started to ease off a bit, but the underweight positions remained, and the dollar actually fell another 15%. So it wouldn't be unprecedented for the dollar to fall even further this year, even if flows are not as strong a driver as they were last year. Valuations, rate spreads, and hedging patterns will still matter a lot this year. If there's a consensus view that I'm happy to run with for 2026, it might be this one. I doubt it will be one way. It never is. Institutions are still massively overweight the euro and Aussie. They're overweight high carry plays like the Turkish lira and the South African rand. But they're underweight the yen now, and they're neutral the Brazilian real, the ultimate carry currency. Not every consensus view is crowded, in other words. And that's a good note to finish on. Some consensus trades won't go so well, but some will probably turn out okay. It's important to keep in mind the overriding consensus forecast, though, that this year will look like a slightly lower volatility version of last year, and that not much is going to happen. That one is almost certainly going to be wrong. And the fun part is, we can't even think of or know the reasons why yet. I guess that means you're going to have to keep listening to the podcast for another year, and also please check out a document that I soft launched last year called The Volatility Current. It puts all of these topics of risk and uncertainty into the context of derivative markets, and it'll hopefully be a much more frequent update on how to think more about how variance drives the most meaningful outcomes in markets. Until next time. Thanks for listening to Street Signals. Clients can find this podcast and all of our research at our web portal, Insights. There, you'll be able to find all of our latest thinking on markets, where we leverage our deep experience in research on investor behavior, inflation, media sentiment, and risk, all of which goes into building an award-winning strategy product. And again, if you like what you've heard, please subscribe wherever you get your podcasts and leave us a review. We'll see you next time.